Hi, my name is Roger Schlater. This video is actually about SBA loans, whether they're a better benefit for the business or a better benefit for the borrower. A lot of B's there. So anyway, SBA loans can be beneficial for both the businesses and the banks, but their necessity depends on specific circumstances and the goals of the business owner and the lending institution. There's some key points to consider, and I'm going to enumerate them here. Benefits for the business is the number one is favorable terms. SBA often come with more favorable terms, such as longer repayment periods. That's a big deal. The repayment period is really anything, almost anything. Even working capital can usually 7, but a lot of times almost anything can go 10 years. And then for real estate, they'll go up to 25 years, which is a big deal. And it doesn't matter which. Most of the programs, I know the 7A and the 504 go up to 25 years. And then lower down payments. The down payment on an SBA loan is usually around 10%. Now it can be a little larger under certain circumstances, but normally SBA loans are 10%. No matter which loan you have, they're always about 10%. And then competitive interest rates, competitive interest rates, I don't know. They can actually go 3.75, I think it is, or 2.75 over prime. So, whatever prime is, they can still go above that. And you're not gonna borrow at prime anyway, being a small business owner. So the interest rate can be a little high, and it's usually variable. But other than that, they are making the loan, and it's not, the rates aren't crazy. They're within range. So anyway, and that can make them attractive to small businesses that don't qualify for traditional bank loans. Traditional bank loans, a lot of times they'll go a lower term. They'll go 20 years for real estate. They'll go 5 to 7 for everything else. And then the interest rate, well, the interest rate might actually be a little better. Usually they're maybe anywhere from 1 to 3 over prime. But the down payment can actually be probably more like 20 to 30% rather than 10 as an SBA. So SBA's got them beat there on the equity you're going to have to put in. The second thing is actually access to capital. For businesses that have difficulty obtaining financing through other channels, SBA loans can really provide access to capital that might otherwise be unavailable. It can be unavailable from banks, it can be unavailable from credit unions. And it really does help them start, expand, and stabilize their operations. Number 3, government guarantee. SBA loans are partially guaranteed by the U.S. Small Business Administration, that guarantee, that guarantee can be up to, certain circumstances, it can be up to 90%. Usually in a 7A loan, it's 75%. And then the 504 is a different ball game. There is no guarantee, but lenders are in 50%, and they get first lien, so that they're pretty much protected a lot. This guarantee does encourage banks to lend to small businesses. The government guarantee is very important. It does encourage banks to lend to small businesses that might not meet all the criteria for a conventional loan. So, SBA loans are partially guaranteed, but that's very important. Support and resources. SBA offers resources and support to small business. A lot of small businesses do not avail themselves to any of the SBA help that could be offered. A lot of times this includes counseling, educational programs, and they have a lot of stuff online, like e-programs online that you can do for free. There is no charge for them. And then they do have access to networking opportunities, which can be valuable for business owners. That's the benefit for the businesses. Basically, you're getting the loan, you're getting it at a pretty long-term basis, which makes your payment less. You're putting in less, which helps you conserve your cash. And your interest rate is not way out there. It's not like some other forms. It is like 2.75 over prime, and it's going to be that way, and it will probably vary with prime. So anyway, the benefit for banks, number one is reduced risk. The SBA guarantee mitigates the risk for lenders as it covers a portion of the loan amount in case of default. This encourages banks to lend to small businesses that they might consider too risky for traditional loans. The best example of this would be restaurants. Restaurants are very risky. You think about a restaurant's been around for 10 years. It's hard to do. There's not that many of them that have. And I'm not talking about, like McDonald's or something. I'm talking about a restaurant, So anyway, if you're if you got a franchise, I mean, those are a lot more stable, I think, at least in the fast food. Now, when you get into real restaurants, I don't know. But anyway, the second thing on banks would be compliance with regulations. Banks are often required by law or regulation to meet certain criteria regarding lending to small business or meeting community reinvestment obligations. Offering SBA loans can be a way that banks can fulfill these requirements. And it is done all the time. I mean, that's a lot of times why banks do it. It does fulfill those requirements that they have, from the compliance from regulators. Anyway, number three is customer acquisition and retention. Banks providing SBA loans allows banks to attract and retain small business customers, build relationships with these businesses. It can lead to additional revenue through other banking services, such as deposit accounts, credit cards, merchant services. The list can go on. The fourth thing in the banks is expansion of their loan portfolio. SBA loans can diversify a bank's loan portfolio, reducing concentration risk and providing additional income streams. Number five is probably the most important one for banks. Banks can sell off the guaranteed portion of the loan, usually 75%, and receive a fee. It used to be from 8% to 12%, and they get their 75% back to lend again. Normally, SBA only guarantees 75%, so that's all that they can sell off. The bank also usually services the loan, and they get a 1% fee for servicing the loan of the loan amount also. So anyway, while SBA loans can be beneficial, they're not necessarily for all businesses or all banks. It really kind of depends. There's some banks that basically make a living off of selling off guaranteed loans, and they make a very good living off doing that. And then there's some banks that don't want to do SBA loans. I worked for a bank that said SBA will not make a bad loan good. So anyway, they obviously did not like doing SBA loans. So anyway, some businesses may be able to secure financing through traditional loans or alternative financing sources, depending on their financial strength, their credit worthiness, and their specific needs. Similar, banks may have different strategies and priorities when it comes to lending to small business. It's important for business owners and banks to assess their individual circumstances and objectives to determine whether SBA loans are really a right fit for them. And banks too. I mean, sometimes it has to be a right fit for the bank. I've seen banks that want to do SBA loans because they want to sell them off, but then when it comes right down to it, they're not looking for SBA loans. They're looking for conventional loans. And I'm sorry, but conventional businesses that can qualify for a conventional loan, a lot of times they're not going to do an SBA loan, because there are some fees with the SBA loan. There's usually around 3% in fees, but banks can charge fees on regular loans, on traditional loans also. So anyway, please subscribe and hit the bell icon to get all the releases. Please also like the video if you got something out of it. My name is Roger Schlater, and I will see you in the next video. Thanks.